Well, hello. I'm Chris McAlpin with Sound Financial Strategies Group, and I'm the Chief Experience Officer. Hope that you're doing well today. I'm going to answer the question, how do you manage risk? And maybe you saw one of my recent videos where I got to ask the question, what is an example of a high risk investment? And my ultimate answer is this. A high risk investment is one in which you, the investor, does not manage your risk. And so you may rightfully be asking, how do you manage risk? Or maybe you really are just a high risk, aggressive investor and you really want to go get it, but you want to be smart about it. And so you want to manage risk, or you're a first time investor, which great, congratulations. You are seeking education. You're trying to learn and you want to learn the proper steps in investing, and you're starting to understand that one of the most important steps in investing is managing risk. Or maybe you're preparing to retire. And all these years you've been an aggressive investor. You've really pushed the envelope to grow your money, but now you're trying to decide what should your asset allocation be? What should your portfolio construction be? Because now you're retiring. You can't go through the ups and downs, or you shouldn't go through the ups and downs like you've always been able to stomach before. And you really need income. Your investments are changing. You want to know, how do you manage risk in light of all that? So, what should you know about risk in general? I want you to remember this. The academic investing definition of risk is this: it is the probability of you losing money. And risk is inherent in almost all investments. However, we at Sound, we define risk like this: it is the probability of you not reaching your financial goals, which that's different. And that aspect of risk, the probability of you not reaching your financial goals, it can be solved in large part with financial planning and discipline, as much as a solid investment framework. And the good news is you control your financial planning and discipline. That's great news. I like aspects of investing that I can control, because I know this: I cannot predict the future and I cannot control the stock market. I've tried. Believe me. Well, at least I don't think it can be done. I don't think you can do it. I know I can't do it. In fact, I know you cannot predict the future. I can leave you with that. How do you manage investment risk? Well, I'm going to give you three ways. Okay. Number one is the most popular way, most common way, most easy to incorporate, and that is diversification. Diversification is owning broad asset classes, owning stocks, bonds, currencies, commodities, especially stocks and bonds. Within each of those asset classes, holding other asset classes, sub asset classes, so to speak. Within stocks, having US and international, large cap, small cap, mid cap, value, growth. Within bonds, high yield, corporate, and government. Or within commodities, different types of, whether it's oil and natural gas or futures and corn and beans, et cetera, or currencies. And look, before you go diving into commodities and currencies, be sure that you go do more homework. But I think you get my point. Diversification matters greatly. And your asset allocation, according to many studies, accounts for 85 to 90% of your portfolio's return. So the number one way to manage risk is diversification. And I know that's a ho-hum kind of an answer, but it's just true. It's been around for decades and generations because it just works. I mean, gosh, Solomon wrote about it in Ecclesiastes 11, 3,000 years ago. Diversification works, and you manage risk with diversification. A second way of managing risk is a little bit more of a subset here, but it's called a stop loss. And that is placing an automatic sell order on your security. You can do this by placing an automatic sell order that is at a certain price, or at a certain percentage loss, and making sure that that order is stated as good until canceled, meaning good until you cancel it. Now, you've got to make sure that you monitor your stop losses, but it is a great way of managing risk. The third way to manage risk is by hedging. And that is trading one security to protect another security, the security that you really want to protect. Take this for an example, and I mean this only as an example, okay? But let's assume that you own Apple stock and you want to continue to own Apple stock because you like the long-term prospects of Apple as a company and you believe that the long-term stock price is going to go up. But you are concerned with the risk of owning Apple stock in the short run. You believe that in the short run, it could get beat up and see some damage. And so you might want to do this. You could go short, sell short S&P 500 futures. Because if the S&P 500 goes down, most likely Apple stock's going down as well because it's one of the largest components of the S&P 500. So if the S&P futures are going down, you would make money while you're losing money on the Apple stock, but overall, you're offsetting your losses, whereby you offset your losses in the short run, and in the long run, you still own your Apple stock for a good, solid investment over the years to come. So those are three answers to the question, how do you manage risk? Diversification, by far and away, number one and most broadly used, and been around for generations and will be around for generations to come. Number two, a stop loss on your security. And number three, hedge a security. But what is the one thing that I want you to remember in this? And that's this. Warren Buffett said the number one rule to investing is don't lose money. And the number two rule to investing is don't forget rule number one. The worst mistakes I've seen in my career are emotional investing mistakes where investors stop managing risk. So you must remember this. You must always manage your risk. It is the most important rule in investing. Good luck. I hope this helps. Take care.